So this was a week where we had some news on Tesla. We also had some news on the markets. Overall, it wasn't a good week for us. It wasn't a good week for the markets. For the year, we're down 44%. The market's down 14%. We're underperforming by 30%. So that's kind of in line. We've had a pretty bad week, but the only silver lining is that according, relative to the beta, we actually did pretty well, meaning we were just down with the market. So what's going on? Let's talk about the market, and we'll talk about Tesla specifically, and then a little bit about NVIDIA too. So there has been an announcement for tariffs coming out of the White House, and the tariffs have been announced in a way. It's a pretty complicated story, and we're not a macro podcast here. We're not talking about specifics and things. They're not even on podcasts. Really, the purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. This is the fundamental thesis. And by the way, sorry, this is Trim Delco. This is not even on podcast. And like I said, for the year we're down 44. The market's down 14. We're underperforming by 30%. So let's get back to the story. I think fundamentally, what's happening in the markets is uncertainty and the fear of a massive recession. The reason there is a fear of a massive recession is because the tariff situation is not clear, and it's very disadvantageous for pretty much anybody else in the world. Now, the storyline in general, the way this is being interpreted by the market, is that we have President Trump putting a very high bar on every, at least major trading partner, and then negotiating reciprocal tariffs with the goal to level the playing field and put a market dynamic in place that is good for the U.S. and like any other trade, of course, should also be good for everybody else. Right now, it's not the case. Right now, we're being disadvantaged in particular by China, by Korea, by Japan, and by Europe, the biggest trading partners, the only really big relevant trading partners that we have, and that needs to stop. So this is in essence what's going on. So you have two ways this can go. One is that the other partners don't cave in. They basically say, okay, we're going to do the same, and then we have more or less a stop of trading for a while. We have a recession, and we have a readjustment of supply chains and trading flows. I would think about 18-month recession, 25% downturn in the market. For us, probably a 40 to 50% downturn in where we are today. So pretty tough situation. The other side, the better side, is of course we have reciprocal negotiations. We have a situation where we kind of settle in a more tangible, fairer way. We can handle the uncertainty. The market recovers. We have a bit of lowering rates by the Fed, and we're back to growth. And we have all this thing behind within 3 months. So this is the positive side. I think I wouldn't be too positive on the positive outcome of this, just because if we look at our main trading partners, they all have their own issues, and whether they even can yield to the U.S. is a big question. For example, Europe is, in my opinion, is a dead economy, and the only thing that keeps a lot of their suppliers alive in global trade is hidden regulation, things like you have to have a certain type of curvature in your cucumbers, otherwise you can't sell cucumbers. Hence, most of the trading with cucumbers is being made impossible. So things like that are being put in place in Europe, and that is of course a problem for them. If we now level the playing field, then we will have they will just have a huge disadvantage. My point here is, I don't know how much leeway they have to really negotiate a better situation for us and for them. Same applies to Japan, same applies to Korea, same applies to China. I've always been of the opinion that most of the companies, not all of them, there are some global champions in all of these countries, including Europe, but overall, most of the suppliers are used to this free-for-all, cheap, low-cost, unfair trading, and they're just not going to be able to yield. So anyway, that's why I'm a little bit more skeptical. as far as the tariff situation is concerned, so I think the most likely scenario is some modeling through where we have some posturing by Trump, posturing by the trading partners, some deals made behind the scenes, and some sort of continuation of the economy. And then we hopefully have maybe a 6-month recession with a recovery and about a 10% downturn in the market with a 25% downturn in the portfolio. This is something that I think we could stomach. This is something we can, I mean, when I say from now, so we could be down another, like I said, another maybe 20-30% in which of course would bring us down to 60-70%, which is massive for a year. We already had that in 23, so it's not actually in 22. Sorry, so it's not the first time we go through this, and certainly it's painful, but that's life. That's life. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund, and losing money. That's how it feels like to run a hedge fund more than anything else. I think you have to watch your leverage. You have to be sure about your positions. You have to be clear about why you're investing, what you're invested, what you expect from your investments. And you have to also understand what the potentials are that you could be wrong. This brings me to the segue now to our main position, Tesla, which also had news this week. We had the volume print for Q1, which came at 336,000 deliveries, 365,000 production, about 20,000 below expectation, so not a good number. Now, it's not the end of the world. We have the Model Y transition, which in our opinion is probably the main reason for this shortfall. There is demand concerns because of the Elon Musk effect and political things, but we don't think that is a big issue. I think that the main issue is the Y transition. So this should be going okay. There's a little bit of a local issue. I call it a local issue because it's not a global thing for the stock, but we are actually witnessing a cannibalization of S and X with Y. So we expect that probably at some point S and X will be discontinued, just because it's going to become more and more difficult for Tesla to make a case for somebody to pay $100,000 for a car versus $60,000 when the $60,000 car is as good, sometimes maybe even better than the other one. So it's just going to be hard to differentiate, which is actually to the advantage of Tesla, because that means that Model Y is such great value that even their own top models cannot compete with the Y, and that means that all the other competitors also can't compete. Now, having said that, we still have to ask ourselves some serious questions, okay? For example, what about competition? And I think competition is something that I would say I spend probably 1 hour a day on average just thinking about that. So nothing else, but just, is there a serious threat of competition for Tesla, whether it's in the US, whether it's coming from China, whether it's coming from Korea or Europe? It doesn't matter where it comes from. The question is there competition for cars, competition for cybercabs, and competition for Optimus? Those are the three big drivers of value in the next 5 years. Of course, there can be competition. I mean, we can't expect a company to be a sole provider of services, but of course, we have to expect them to be a leader. We have to expect them to be a couple of years ahead of everybody else in order to capture enough market value. So let's start, or let me give the conclusion first, and then we'll talk about the details. The conclusion is yes, Tesla is competitive. Tesla has enough competitive advantage relative to everybody else, and that is because of manufacturing. So the real competitive advantage of Tesla is in manufacturing. It's actually not in software, it's not in design, it's not in marketing, it's not in the brand value, it's not in Elon Musk, it is in manufacturing. Now, what do I mean with manufacturing? What I mean with manufacturing is a more comprehensive look at it's a more comprehensive look at the way products are being scaled. Right, so you have a car which is being produced, and what you want to make sure is that car can have the lowest cost per mile. The way you achieve that is by lowering the cost of production and also increasing the miles driven with the lowest cost of total ownership. And that is an optimization problem that, in my opinion, no other competitor is focusing on, not Chinese, not European. That has other reasons that I don't want to go into right now, reasons such as, for example, traditionally car manufacturers have become marketing companies, they've hired the wrong people for the wrong problems, things like that. I think this is a more comprehensive problem, like I said. You can do many business school studies to analyze this. But I would say, as always at Orange Capital Partners, we focus on the Clayton Christensen approach towards analyzing a company, and that always starts with the cost. So what do I mean with that? So what I mean with that is that a company is fundamentally defined by its cost structure. And the cost per mile is what's going to drive the future of transportation, and Tesla is going to be a leader. In fact, we believe that Tesla is going to be by far the lowest cost provider per mile in the market. Now, whether that is you buy a car and drive around, or whether that is it's Friday night and you're in Amsterdam and you leave your offices, you call your cyber cab or your own, cyber Model Y or whatever, and you punch in, Biarritz, and then you wake up next day in the morning in Biarritz because you played some video games, watched a movie, and then slept throughout the night in your car. Whether that is the kind of miles you drive, or whether it's the traditional miles you drive, that's not even that important. What matters is lowest cost per mile. The way you achieve that, again, is lowest cost of production, highest possible miles, lowest cost of total ownership. That means the operational cost. Things don't break. You don't have to replace things all the time. You don't have expensive sensors that break, all of that kind of stuff that Tesla has. So we think that they have an advantage on the car side. Let's talk about Optimus. It's the same point here. The differentiation, as far as Optimus is concerned, is not going to be on the software side, at least not for Tesla. It looks to me that market is a lot more competitive, and there's a lot of people who are on it. It's also thanks to the massive advances in AI, particularly foundational models for robotics, things along those lines. We've spoken about this extensively on this podcast. We've spoken about whether it's 3D reconstruction of images, whether it's mechanical engineering problem solving for specific robotics problems. The whole range, foundation models, what physical intelligence is doing, all of these things are contributing to a better grasp of the robotics problem and a faster, more rapid, solution-driven approach towards robotics that will enable robots in the next 2 years to do tasks. Now, we believe that the humanoid robot will be housed in places where humans don't want to be, should not be, or cannot be for risk reasons. And there's a lot of tasks like that. There is, hazardous work. There is terribly boring work. There is dangerous work. There's expensive work that you just can't find people. You have to pay them a lot. So there's a lot of reasons why you want to employ these things. And Tesla, again, will have an advantage because obviously it's not going to be cost per mile. It's going to be something else per something else, right? Whatever that thing is, you bet that Tesla is going to optimize for that. So it could be, problem solving per dollar or something like that. But fundamentally, Tesla, again, here is driven by low cost of production, high durability, and low cost of operation. So those three vectors, again, that's the DNA of the company. That's what they're doing, by the way, with SpaceX also. This is the key. Okay, again, low cost of production, high durability, so you have more per dollar that you pay for the thing, and then also the actual maintenance of the thing is relatively inexpensive. We see a lot of videos from China. We see a lot of posturing from other companies. That's fine, but we don't believe that is what people are optimizing for, because that's not what we're seeing. People are optimizing for backflips or that kind of stuff, YouTube video stuff, TikTok stuff, which is fine, but that's not going to drive, hundreds and hundreds of thousands of units sold. So where do we stand here? The conclusion is that as far as our position is concerned, we have a lot of conviction for the reasons we just outlined, that Tesla will become a very valuable company. Within the context of that, of course, we have to think about, okay, what does that actually mean in a down market? So let's say we are now at roughly, maybe $3 a share at, 250. That's like 80 times earnings. And that's very expensive in a recessionary market. This could go down 40 times earnings. So we have, a halving, down 50% from where we are today, which of course is brutal and very, very difficult also for us to sustain from a leverage perspective. Now, if that happens, then that happens, of course. But the point here is that how could this look going forward? Like, could we see meaningful earnings per share appreciation in the next 1 or 2 years? The answer is no, probably not in the next year, maybe not in the next 2 years. That's the problem. That's why the stock is very volatile, and that's why we could have a massive drawdown. However, if we can see some meaningful traction in sales of FSD, cybercap adoption, and the first signs of Optimus actually being sold for something more than just test markets, and also deliver some earnings. We also have the energy business keeps growing. If we could see those combinations, then potentially we could have a sustained higher PE, so maybe 60. And if we get 350, 60, that's about $200 a share. So if we could settle in around $200 a share at the low point, then that is certainly something we can stomach with no problem. So what I'm trying to do here is, and this is very important for people who are interested in this series, because they want to understand how it feels like to run a hedge fund. Like in situations like this, your objective should be to work with the worst case scenario, to have contingency planning in place for what happens if we have this type of drawdown, recession, all these kinds of things. You want to be ready to sustain a massive drawdown. And if we don't have that, then that's fine. I mean, you can handle the upside. What you need to be able to deal is with the downside. And again, we're very close. If we have a 50% drawdown from here, we would probably hit some margin calls. So that's a problem that we need to address. And one way to address this is to start selling a little bit ahead, which we might do at some point, depending on how the markets react. Of course, we don't want to be sellers in this market, but we always have to be conscious of margin calls and things like that. So that's number one. Number two, we also want to be conscious of cash management in terms of having actually dry powder to buy, because there could be also a situation where we actually want to increase the leverage now because we see some fundamental upside. So for example, if the Model Y ramps faster than expected and we have a cybercab launch and we have maybe some other Easter eggs that are thrown our way, we could have the stock go up much faster, and we would anticipate this and then maybe be able to even buy, which we also did in the past. So we want to be flexible. We're not big traders here at Orange Capital Partners, but we are conscious of these types of situations. And it's important to be on your toes all the time and be ready for this. So I think, again, the conclusion is, on the macro side, we believe that there is deliberate uncertainty produced by the Trump team to get the tariff negotiations through. We also have Doge. We have lower government spending. We have lower interest rates. So those are positive things, excuse me. On the negative side, we have a toxic political environment in the country. We have riots in the streets. We have bipartisan Congress, which is difficult to deal with. And also we have lots of uncertainty in the job market. So people will probably be a bit more cautious. But let's not forget the productivity boost that AI is going to produce is going to drive real growth in terms of profits, in terms of sales, things along those lines. So that is That is definitely a positive. I know for some people this might be maybe a little bit too short-sighted. You can't just say, well, we're going to replace people with AI and that's a good thing for the economy. That's not how we're seeing it, of course. We don't want to be inhuman when it comes to these types of things. But we just have to look at it from an economic perspective, what it actually means for a country like the United States when, let's say, you have 80% of the workforce increasing the productivity by 30%. That is, you can do the math, right? That is real growth. That means less people can do more, profits go up, productivity goes up, more businesses are started, more problems are solved, more iteration is possible. With more problem solving, we can create new problems and solve those and grow and create business. So all of these things can happen. This is what's happening. We have a technological revolution at our footsteps, and this is also part of the macro picture. So while the news now are all negative because of what happened in the White House 2 days ago, we also have a lot of underlying positivity. As far as our positions are concerned, again, we're positive on Tesla. As far as NVIDIA is concerned, all of these AI things are driven by NVIDIA. The competitive landscape there is not concerning. The tariff landscape is a little bit more concerning because NVIDIA is very much embedded in global trade. They have to sell to other countries. The good news is that they're monopolists because they have the lowest cost per. And like we said many times, we at Orange Capital Partners, we invest in companies that maximize for lowest cost per something. And those are the long-term winners.